All right, so we're continuing with our intro to financial mathematics. And so this is definitely a topic that you're going to see in your life. So places where you might use math of finance anytime you buy a car, buy a house, maybe pay off student loans. Hopefully you don't have too many of those when you get out of here. Credit card debt, hopefully something you don't have to deal with, but a lot of people do. And then things like saving for retirement. Okay, so definitely an area of mathematics that you're going to see when you get out in the real world. So we're going to talk about some basic definitions. First we have interest. So when we're talking about interest, we're always going to use a capital I, which is the most common, but you'll see that on the formula chart. And this is going to be the price the borrower pays for the use of the lender's money. So for example, if you take out a car loan, you have to pay back the price of the car, but you also pay the bank interest. Okay, so that's how much you paid for borrowing the money. And then next we have principal. And the principal, usually we use a capital P for this. And this is the amount given by a lender to the borrower. Okay, so it's basically the amount of money you borrow. So if you're buying a car for $10,000, maybe you borrow the $10,000 and that's the principal. Then of course we have the interest rate. So for interest rate, we typically use a small r, and that is the rate paid by the borrower to the lender for use of the principal for a specific time period. Okay, you have smaller time periods on things like car loans. Those are usually 5 years, so you'll pay maybe 5% a year on the principal in interest. Or if you have something like a mortgage, it may be a 15 or 30-year loan. So speaking of time, that gets us to term. So you can think of term also as time, which is handy since they both start with the same letter. And this is going to be the duration or life in years usually of the loan. Okay, so like I mentioned, car loans are typically 5 years, mortgages are typically 30 years, but you can get other terms. Okay, next we have what we're going to call the repayment schedule. And this is a schedule that is agreed upon by both the borrower and the lender for the repayment of the loan. All right, next we've got some different types of interest. We have simple interest, which you might guess is the simplest. This is interest applied to the principal only. So no interest on interest. Typically things like car loans are simple interest. Then we move up to slightly more complicated. We have compound interest. And this is interest that is applied to both the principal and the previously accumulated interest. Now, if you're putting money in an investment, let's just say you win the lottery and you put a couple $1,000,000 into a savings account, then you become the lender and the bank becomes the borrower, because the bank uses your money that you put in the bank and then they pay you interest for the use of your money. So if you're getting the interest, you want compound. That way you're earning extra money on the interest itself. All right, so now let's look at the next page. All right, so now we're looking a little bit at rates. So we have the annual percentage rate. You may have heard of this as APR. Hold on, let me go back to my yellow highlighter. So APR, and this is going to be an annual, meaning yearly, interest rate expressed as a percent of the principal. And this is a little bit different from annual percentage yield, which is APY, and that's one you may have also heard of. This is also going to be an annual percent increase of the value of the investment, taking into account the APR and the compounding frequency. So for example, if you're making 5% interest on the principal, then if you add in the interest you're making on the interest, it will go up a little bit above 5. So what happens is the APY is always a little bit bigger than the APR. All right, next we have future value. And for some reason, we tend to use the letter S for this. And this is the amount the investor collects or the borrower pays at the end of the term of the investment. So I tend to think of this as the total amount paid. So if you bought a car, you paid back the price of the car plus you paid all the interest. So if you put all of everything you paid back, that's what we're calling future value. Future value is used a lot to help calculate your credit score. All right, now we have the periodic interest rate. And this one's one of the trickier things that we do. This one's a little I. And we'll see in our formula chart that the periodic interest rate is R divided by M. Now we've already seen R, that's going to be the interest rate. And then M is going to be the number of times compounded per year. I think I need to go back and make that fraction bar a little bit bigger. All right, so if you're compounding monthly, then M would be 12, for example. If you're compounding weekly, then M would be 52. All right, so this is obtained by taking the APR and dividing it by the number of times the interest is compounded per year. Okay, so just as a quick example, let's say you're getting 3% interest compounded monthly. Then I is going to be the interest rate, which is 0.03 as a decimal, divided by 12, and that would come out 0.0025 or 0.25%. So that gives you the interest rate just for that small period, okay, not for the entire year. All right, next we have continuous compounding. This is interest compounding infinitely over infinitely small compounding period. So basically every time you get so much as a penny in interest, it's compounded and you're earning interest on that. All right, down to our last couple, an amortization. This is the process of paying off a loan by making regular installment payments. So think about your mortgage or your car loan, things like that. All right, a future value annuity. This is the amount at the end of the term of the investment. And the lump sum is in the future with interest increasing as time passes. So future value annuities are common when you're talking about things like retirement, and you're trying to figure out how much money you're going to have maybe in 20 years so you know if you have enough to retire. All right, then we compare that with present value annuity. And this is going to be the amount at the beginning. All right, so not at the end like the last one. The amount at the beginning of the term of the loan, and the lump sum is in the present with interest decreasing as the loan value decreases.